After a strong first half of the year for most assets, in the third quarter, many risk assets had negative returns. For example, world equity markets, global high yield, both down around 2%, commodities far worse. There's no shortage of reasons why those risk assets might have had negative returns: geopolitical questions, growth questions around the world. But another is simply the swirling headlines for investors questioning if markets have become too rich. No shortage of those. And if you marry that to the idea of low volatility, in large part brought on by accommodative policies, many have been questioning if markets were simply becoming complacent. So what do you do as an investor? Let's go back to the basics and take a look at the fundamentals. Global growth continues to be moderate, but improving, we expect, over time, with divergent fortunes. The U.S., we still believe, is a standout among developed nations and should strengthen as we move forward. There's an easy way to show this, and we've done it before, taking a look at three key survey indicators. For example, consumer sentiment continues to climb and did in the third quarter, as you see here. Also, new home sales expectations have firmed up even further. And finally, the all-important manufacturing PMI is still in solidly expansionary territory. And more importantly, one of the questions that was asked in this survey was about commodities in short supply. One of the surprising answers? Labor. And that brings us front and center to the debate at the Federal Reserve. Well, the quantity of labor, as measured by the unemployment rate, has gotten better and better. There's no denying that, and now sits under 6%. But the debate is shifting to the quality of labor. But even there, we see things like the underemployment rate getting stronger, and therefore expect the Federal Reserve to move more or less on its path, low and slow, over time. You can see that here in the summary of economic projections. But the important line most likely is going to be the markets line, because that's what really moves the markets. For example, in the spring of last year, in 2013, markets thought the Fed would be more aggressive than what they were indicating, and today, as you can see, they think the Fed will move more slowly than what they're saying. But if the Fed proves out to be right, markets will have to adjust, and that will bring volatility. But the Fed is nearly alone in the developed markets on the idea of raising rates. The ECB has cut rates and is adding more stimulus. The Bank of Japan continues to stimulate, and that's an important point to bring up. Because where you have divergent economic policies, you're going to have divergent yields. We showed this last quarter to underscore why U.S. yields were lower. But it also brings up another really important point. Where you have divergent yields, you have divergent global bond returns, and it's why we continue to talk about diversifying your economic cycle risk by owning different nations. That's also true of the credit markets. From a bottom-up perspective, we can show you many issuers from around the world in many areas of high income, and that's a rich tapestry of opportunity. So use those together and effectively. But I want to introduce you to one other risk premium in fixed income that's critical today, and it's the notion of liquidity. What is liquidity, you ask? It's the cost of transacting, of getting someone to buy your security in difficult markets. For example, in 2008, the cost of getting out of a high-yield bond, about 800 basis points. And if that's disconcerting to you, keep this in mind. Today, U.S. credit markets are twice the size as they were then, and the amount of inventory available has plummeted. So liquidity would be far more challenged. So if you're a bond investor, you have to keep three things in mind: rates, credit, and available liquidity in building your overall portfolio. And speaking of overall portfolios, I'd be remiss if I didn't talk about the equity markets and opportunities there. Three things generally drive equity market returns. One is going to be earnings growth, the other is dividends being paid, and finally, multiple expansion. And since we've come out of the crisis, there have been different drivers, but when taken together, a very tidy 20+% return. We don't expect that going forward, and have a more modest expectation of a little below 7% over the next 5 years, driven by earnings growth that falls in line with a solid U.S. economic growth picture, dividends being paid, but not much, in multiple expansion. But there's more available to you than simply the market's return. There's also opportunities for active stock pickers. This is intermarket correlations. As money moved out of active stocks and into passive stocks, these correlations climbed, but they've been falling, as you can see, and that underscores the opportunity to choose wisely from among companies. And we've seen the fruits of that labor show up in rolling returns, where active managers are now outperforming the index over the rolling 1-year period. So taken all together, let's bring this home. There will always be headlines, but today, stepping back to the fundamentals, we envision moderate but improving global growth, low levels of global inflation, and accommodative policy on a global basis. From a portfolio perspective, With your fixed income, balance rates and credit, be global, be diversified, don't reach for yield, but also incorporate liquidity concerns as we go forward in the availability of cash. And on the equity side, while returns are expected to be somewhat modest, they're really attractive relative to other things, and if you're an active stock picker, there are chances for you to add value as we move forward. So with that in mind, always pay attention to the headlines, but never too much. And with that, I'll see you next quarter.